Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and founding partner or member of the Dividend Kings subscription service on Seeking Alpha. And this offering is going to be looking at the Dividend King Super Swan Fortress holding that was recently recommended by my associate Dividend Sensei in a wonderful article where he really illustrated the impeccable quality of this great business. What I'm going to do here, the only place we disagree, and we disagree only modestly, I want to add, I would be in favor of buying this stock here if you're a long-term investor looking for impeccable quality on the argument that you can pay a slight premium. However, I'm not as sanguine as my colleague on the current valuation. I think Illinois Toolworks is currently fully valued or at the upper end of the fair value range. But one of the things that we talked about, he and I have talked about numerous times, and he agrees, and I with him, is that you should run valuation or evaluate valuation utilizing multiple metrics. So what I'm going to do here with this article or this video is I'm going to go through Illinois Toolworks using some of my favorite valuation methodologies to kind of illustrate how I approach valuation and why I actually believe Illinois Toolworks is modestly overvalued, but only modestly so. So let's start by looking at operating earnings on Illinois Toolworks. And what I want you to notice is the company's grown earnings at a rate of about 8.5%. That's a above average growth rate. But I do want to make another point here. I want to go into the forecasting graphs and look at our historical compound annual growth calculator and utilize this drop down because I want you to see these are all historical growth rates. There's no forecasting data in these numbers. I want you to notice that recently, the more recent years, this company has actually grown earnings at double-digit rates. However, if you look, at the long-term rate, you'll see several times, or a few times I should say, where the growth rate got down into the 8% range. I would consider something in the 7 to 8% range as the most conservative growth rate you could imagine. So I'm going to apply that here on a forecasting graph. And these orange lines here would represent my valuation corridor. So this is at the upper end of the valuation corridor based on operating earnings using the lowest historical growth rate that the company has achieved. And this would indicate at a fair value 15 PE about a 6.5% annualized rate of return. But if I look at normal PE ratios, you can see that this stock has traded at as high as 21 PEs historically and has traded as 18. These are also historical normal PEs. So an 18.5 PE that Adam referenced in his excellent article, really covers that. So if I use an 18.5 PE here, then we would argue that this has the opportunity to generate about an 8% rate of return over the next couple years, including dividend income. But getting back to historical growth rates, I think it's important that you could apply even a 10 or 11% historical growth rate to this graph. And then at that point, going out kind of longer term, we start getting into that 9.5 or even the 10% at a 15 PE annualized rate of return that Adam talked about. If we use these 18 normal multiples, then we get to the double-digit numbers. So these are all practical, realistic opportunities for this company to grow. So when I shorten this time frame here on this graph, you can see that the growth rate historically has been about 11.95%. We'll call it 12% using adjusted operating earnings. And for that basis, the stock is clearly undervalued. And if it traded at its normal 20 PE, then, from the time that it was recommended here, I want you to see it would generate about a 12.8% rate of return. So far, so good. But let's look at some of the other valuation models. One of the things that Adam talks about, he likes the 5-year historical dividend yield theory, I guess, of value. I look at it a little differently. Here's FastGraph's version of that. This is the annualized dividend yields, year-end dividend yields for the company going back to 2000. I can also run this, by the way, as about that 5-year number that Adam talked about in his article, where the current yield is higher on that basis. Looking at just these last 5 years, this would be high. But if I look at it longer term, at over the last, say, 18 to 20 years, I do want you to notice that as a valuation reference, the year-end dividend yields are a mirror image of valuation. When the valuation of the stock, when the price is above the orange line or overvalued, or when the dividend yields are lowest, here we have a 1.2% year-end dividend yield in 2001 with a high valuation. When the valuation got very, very high in 2018, we can see that it only had a 1.7% annualized yield. It ended last year at 2. 2.8, and the current yield's about 2.7, but this is definitely on the high side of its historical yield. So that would indicate that we have a fair valuation here for Illinois Toolworks. This would not tell us that it's overvalued. It would tell us that we have a good valuation using the dividend yield relative to the operating earnings. So I like that. But now let's move on to a couple other important metrics. I'm not going to go through all of them. I'm just going to go through some of my favorites. I'm going to take a look at operating cash flow. Now, I like to value dividend aristocrat type, dividend king growth stocks using the cash flow, operating cash flow as a valuation reference. And here we see that the normal priced operating cash flow over the last 20 years has ranged between 15 and we'll call it 16 times operating cash flow. Company currently trades at 16.7. Again, that doesn't indicate overvaluation. That simply means the stock is on the upper end of full value relative to cash flows. If I go to my forecasting graph, here's my valuation corridor, my 5 companies that's kind of, just above the first light colored orange line, which again indicates full valuation, not low valuation or undervaluation, but certainly not overvaluation. This would indicate about 8.25% rate of return going forward. Not bad from an operating cash flow, so the company looks good. Now, the other thing that I like to look at operating cash flow, and I even go as far as to take price off of the graph when I do this, I want to make sure operating cash flow is covering the dividend. This company has an impeccable dividend record. Its historical dividend growth has been wonderful, averaging over 13% a year. Even the last couple of years, it's actually probably done better than that, where it's really had some great dividend increases. So this is truly an impeccable super swan, dividend king, fortress holding on the fact that the company has increased their dividend, and it's done it through every recession we've had recently and every recession we've had over the last 55 years. I want to mention that. I next like to look at free cash flow. This to me is kind of an acid test when I'm looking at evaluating a company's ability to cover their dividend. So I'm going to leave price off the graph here. I'm really interested in our free cash flows higher than the dividend. And again, Illinois Toolworks would get an A+ on that regard. By the way, the company is A+ rated as far as Standard & Poor's. It has modest debt of about 54%, but as you've seen here just in these last 2 screenshots, the company generates enormous amounts of cash flow, so I'm not at all worried about their dividend coverage. That's really super. So let's move on to another valuation favorite of mine. Let's look at EBITDA, or earnings before interest, taxes, depreciation, and amortization, which Adam also mentioned in his article. When I look at Illinois Toolworks from a standpoint of EBITDA valuations, probably the worst valuation reference that I find here, I would consider the stock based on a normal price to EBITDA of about 10.5 at 12 times EBITDA. I would consider it overvalued here. Again, this is one metric so far out of 5, 6, or 7 that I've covered here that would indicate overvaluation. But if I look to the future, it really isn't that bad. If I look at estimates on the company as far as long-term growth rate of EBITDA, I wanted to go here, I still have a 6 or 7% rate of return. And again, I'm in the upper range of my fair value based on EBITDA. So really not too bad there. There's one other metric I would like to turn to and look at here, and it's Warren Buffett's favorite metric. He was referenced, I believe, in the article, and that's owner's earnings. Okay, when I look at Illinois Toolworks from the aspect of valuing the stock on a basis of owner's earnings, I get also a perspective similar to EBITDA where the stock is moderately overvalued based on how on its normal, multiple of owner's earnings of around 14, and 15 would indicate a fair value. But to keep in mind, that's also skewed by coming out of the recession. So we get full valuation look at operating earnings. But now I would like to go back to my adjusted operating earnings, and what I want to do is I want to come up with what I consider to be my final valuation reference, the one that I personally probably hang my hat on the most, and that's earnings yield. So let's talk about earnings yield and how it's calculated. First of all, earnings yield is simply the inverse of the PE ratio. However, in order to determine that, we have to take the earnings and divide it by the price. Now, we have earnings listed at the bottom of the graph, and a lot of sites utilize trailing 12 months. A lot of sites would use forward earnings. With fast graphs, I like to use a blended earnings number. And let me show you how that blended number is calculated. You can see last year the company earned $7.60. Next year, it's expected to grow by 4%. This is kind of a weak year, which might, by the way, explain why we've had some stock price weakness here recently that brought it back into a valuation range that attracted Adam, as an example. And we got $7.90 for 2019. So if the first thing I do is determine what the earnings are, if I take the current PE ratio of 1893 and I divide it into the $146.87 stock price, I get $7.76 rounded of earnings. I want you to notice that 760 was last year's, 790 is next year's, 776 is in between because we're obviously halfway through this year. So that's the earnings number that I'm going to utilize to determine my earnings yield. So I take that number, 776, and I divide it by the price, yesterday's close of 146.87, and I get an earnings yield of 5.28%. Now, the 5.82% is below my minimum threshold of about 6.5. And let me explain why I get that. If you look at the 200-year average rate of return on stocks, you would discover that it comes out to about 7%. Some sites say 6.8%. So over the last 200 years have outpaced every other kind. And, we look at the number, you're going to see that, there's occasionally you're going to get 10% numbers, but 6 to 8% has been the classic average historical return from stocks. So the reason I like an earnings yield of 6.5 to 7 is because that mirrors what the stock market has given on average over 200 years. It's what stocks give you as a return. But let me explain what earnings yield means, because I think this is really why I consider it such an important valuation reference. If you invested in this company, if you bought 100% of this company, you were the sole owner. What the earnings yield is saying is that if the company gave you every dime's worth of profit it made, and of course companies don't do that. Remember, they pay out a portion of earnings as dividends. The payout ratio on Illinois Toolworks has averaged about 46% in 2018. It's expected to be about 51% this year. So let's say they pay out about half their earnings, so that would be half of that 5.2% earnings yield comes to you in dividends. There's your 2.72%. But is a 5% return, in other words, if you invest your capital in this company and it's only returning you 5.28%, does that compensate you for the risk? In the case of Illinois Toolworks, the fact that it's slightly lower than the 6.5% might be relevant considering the quality of the company that Adam so wonderfully represented in his article, and as I've tried to explain throughout this video and the little short write-up that I did on the company. So it is a premium, but again, I personally would like to see this stock a little cheaper before I bought it. I'd be interested in buying this stock around maybe 125 or 30. Then at that point, it would become very attractive to me. But at 146, I consider it fully valued but not overvalued. Anyway, this is Chuck Carnevale looking at Illinois Toolworks over numerous valuation methodologies that I like to analyze when I'm evaluating stocks. I would like to end, though. I forgot to do one thing. I do want to add it. If you look at Illinois Toolworks from a standpoint of its ease of estimates, the analysts have been pretty accurate with this company historically. On the 1 year with a 10% margin of error, the company has only missed estimates about 20% of the time. And the misses, when you evaluate those, have been relatively benign. They've been a few, and mostly happened during the Great Recession. They did miss in 2013. When analysts were making the estimates 2 years forward, they missed it during the Great Recession, which is understandable, and they missed by a little bit again in 2013. So if you look at that from a standpoint of the historical numbers, 2013 was a slight down year. This company is moderately cyclical. Only on earnings, though. The dividend record has been impeccable. Anyway, thanks for watching. If you like this video, don't forget to subscribe to our YouTube channel. And also, you might want to take a look at subscribing to the Dividend Kings. It's an excellent service that provides a lot of opportunities for investors interested in dividend growth stocks. Thanks again.